China's annual inflation rate surged to a 28-month high of 5.1% in November, according to newly released figures, in spite of government efforts to increase food supplies and end diesel shortages.
The consumer price index increase rate in November is indeed out of many people's expectations. From the changes we can see, the CPI increase rate has expanded, and increased food prices, housing prices and clothing prices are the main contributors to the CPI increase.
It was the fastest rise in consumer prices since July 2008, when inflation reached 6.3%, and much higher than the government's full-year target for 3%. This situation may lead to fresh interest rate hikes. The new figures continue a trend of steadily rising prices this year, in spite of government efforts to cool a nationwide investment boom. Experts say the root cause of the problem has been a flood of money coursing through the economy, caused by stimulus spending and loose bank lending, brought in to help China recover quickly from the 2008 global crisis.
The simple explanation is rising costs. Wages, for example, have jumped sharply in China's coastal provinces this year. China's real estate bubble has driven up land prices, and that in turn has driven up rents.
The effects of economic overheating on Chinese inflation have been worsened by a particularly large increase in the price of food, which weighs heavily in the basket of goods used to calculate the country's consumer price index. High global market prices combined with harsh weather at home to push the price of food 11.7% higher in November year on year. Soaring food prices are particularly sensitive in a society where poor families spend up to half of their income on food. Mindful of possible social instability, the government has been selling off state stockpiles of necessities, imposing price controls and cracking down on speculators and hoarders. Rising incomes and wages may have helped to offset price hikes for some, but for many the inflation outstrips any rise in wages. And the central bank has ordered banks to keep more money in reserve for the 6th time this year, as the government is trying to stem the flood of liquidity into the economy, which is fanning the inflation problem. This followed a pledge from Beijing last week to shift its stance on monetary policy next year from relatively loose to prudent. Stephen Rebay, Press TV, Beijing, China.